Lending Club, ticker LC, is a stock that I think can double my money in the coming years and is becoming extremely undervalued. I've already made a super in-depth video on my channel covering all of my research on the stock right here, but I'll do a quick recap for you right now. Then, with high inflation and rising interest rates spooking the market, we'll talk about whether or not they're a good stock in a high inflation, high interest rate environment. Lending Club is a fintech and bank hybrid. Put it in the group of stocks like SoFi, Upstart, Affirm, but in my opinion, it's better. The majority of their business comes from originating loans, specifically unsecured personal loans. And if you have no idea what that means, don't worry. Essentially, they find people who need to borrow money, roughly $5 to $10, all the way up to $40,000 on average, to consolidate their credit card debt or make a big purchase like a medical bill or a big ticket item. After lending that money to someone and creating a loan, that loan generates interest. Someone's paying them to borrow that money, which gives the loan value. Lending Club can either sell that loan to an investor or institution, or Lending Club can keep it for themselves on their balance sheet and collect that interest directly and make money from it. So yeah, right now it just sounds a lot like a bank, but that's the amazing part about this stock, is that it is, again, a hybrid. On the fintech side of things, they have a proprietary AI machine learning risk model that's able to assess someone's credit risk pretty much immediately. In a similar fashion to Upstart, they take thousands of data points about one person, and they're able to go much deeper in their analysis than the traditional FICO score to determine your credit risk and whether or not they can loan you money. This data, combined with their risk model, allows them to reach way more people and will provide way more loans that the FICO score would usually exclude and ignore. And LC has been collecting this type of data on their borrowers since 2006, or for 15 years, and that's resulted in over 150 billion cells of data to make the best decisions possible. Their risk model also resulted in 50% lower delinquency rates compared to competitors amongst prime borrowers, and 80% of their loans are now automated, meaning the decision on whether or not they can grant a loan is made on the spot within just hours 80% of the time. And again, because they operate as a bank, which other fintechs like Upstart cannot do, they're able to keep those loans that they originate on their balance sheet and collect that net interest income, making them much more profitable over the long term. This is also a massive source of recurring revenue, and keeping these loans for themselves is actually 3 times more profitable for the business than selling it to an institution or investor. This is all probably why in their most recent quarter, they nearly tripled their earnings quarter over quarter, growing net income by 190%. An important note too is that their earnings were also negatively impacted by $51 million this past quarter, meaning earnings could have been over $78 million for Q3 if it weren't for a certain accounting rule called CECL accounting and revenue deferrals. They also just announced that their auto refinance loans are now available in 40 states, covering 94% of the US population, and borrowers have saved an average of $4,000 over the life of their loan after refinancing with Lending Club. This could be huge growth catalysts in the future. Finally, their valuation. They're trading at just 2.27 times next 12 months EV to revenues. And the last time they traded this cheaply was March 2021 during this year's crash of growth stocks. And even if we go back all the way to 2018, the average trailing 12 months EV to revenue of fintech stocks hasn't even been that low in years. And Lending Club's 2.27 times next 12 months EV to revenue is also 5 times cheaper than Upstart's 10.97x, even after Upstart's big drop over the last month. Again, the video down in the description covers my entire thesis in much more detail for Lending Club, but the point of this video is to determine whether or not this investment can still weather a high interest, high inflation environment. Let's get into it. Also, feel free to check out the investor community through the link below or the pinned comment. It's less than $1 a day to get weekly lessons from industry professionals. Nick, for example, who's a mentor and senior wealth management analyst, just did a private live stream analyzing C Limited as an investment with attached Excel files for their financials and valuation, so it's pretty incredible. Definitely check that out down below if that interests you. Although they have the edge of a fintech company, with Lending Club operating essentially as a bank and the overwhelming majority of their revenue coming from demand for personal unsecured loans, there are a few questions in a high interest rate environment. 1. Will demand stay strong for unsecured personal loans? 2. Will revenue streams be damaged for Lending Club, or will they actually see a bump? And 3. Will borrowers from Lending Club start to default on their loans, meaning they'll stop making payments and missing payments? First up is loan demand. Will it go up or down? Personally, I think if we just see some rate hikes, LC will do just fine and perhaps even benefit. But if we see a recession, that's a whole different story. Usually, higher interest rates are bullish for banks because they earn more money, and LC would likely stand to benefit from this as well. Not only because their rates would rise, but also because their loans are often used to refinance. So, say your credit card rate starts shooting up, well, you may need a loan from Lending Club even more than before. However, in a recession or economic meltdown, we would see delinquencies and defaults likely rise on their loans, but we'll get to that in a second. Again, the type of loan that Lending Club offers, unsecured personal loans, is often the kind of loan that you'll use when you're in a bit of a financial pinch, and it'll help tie you over. I was looking for macro level data on the performance of unsecured personal loans in recessionary periods, and I came across payday loans. Now, payday loans and the type of loans that Lending Club offers are not the same. Payday loans are smaller loans like $500 a pop, and they're usually due in full on your next payday, hence the name. But they're predatory. They take advantage of those who are struggling financially in a serious way and charge absurd interest rates in the hundreds of percent. Lending Club is not predatory, and they generally deal with higher income borrowers with FICO scores around 700, but I figured this could give us insight into the demand for personal loans that are meant to help people scrape by in times of financial hardship or recessions. So this study found that quarterly revenue for publicly traded fringe banks, aka banks that issued payday loans, grew steadily throughout the recession, while the revenue of all other corporations fell sharply before recovering. This would of course suggest that payday loan demand grew throughout the recession. Again, not a perfect comparison, but it does give us some insight into this area of consumer debt during financial crises. And lastly, a bearish perspective could say that consumer spending may go lower in times of higher interest rates, because higher interest rates are contractionary by nature, and if most of Lending Club's loans are to pay off credit card debt and people are spending less money, they will likely see less demand for personal loans. So let's talk about how their revenue streams and revenue profile would be affected. So the revenue profile is made up of non-interest income and interest income on their income statement in their quarterly report. Non-interest income sounds great at first, but you'll soon realize it's made up mostly by marketplace revenue and then other non-interest income. So much of marketplace revenue, or pretty much all of it, still depends on loan demand, because marketplace revenue is technically non-interest, but it's the origination fee that they receive from selling loans they've originated to investors and institutions. So if personal loan demand drops, so will their marketplace revenue. And here you can see just how much of their revenue, pretty much half, is still from origination fees. Other non-interest income is just over 10% of total net revenue, and it's mostly made up of things like custodial and other fees, service charges, gains and losses on other non-interest income. Then of course you have interest income, which is income from loans that they've held on their balance sheet for investment. This would obviously be directly affected by rising interest rates. However, in a recent fireside chat with Credit Suisse, LC noted that much of their loans are relatively short term, so they shouldn't be very much affected by rising interest rates. The fear here is that you issue a loan that is too long and is locked in at a certain interest rate. Meanwhile, inflation and other interest rates keep climbing and your loan is locked in at this lower level. But again, because Lending Club's short-term loans are relatively short-term, they're able to reprice these loans pretty frequently every time they issue new ones, so they should be able to keep up. The next concern is what's called net interest margin. So first we got to go back a little bit and realize, where does Lending Club get the money for them to be able to service and provide these loans and keep them on the balance sheet? They get that money from the money that people deposit into Lending Club Bank. So Lending Club has to pay those depositors an interest rate on the money that they're keeping with Lending Club. That's an interest expense. They can take that money and loan it out, but they have to pay interest on it, so you can think of that as like their cost of this capital. But Lending Club takes this money and they loan it out to borrowers, and those borrowers pay Lending Club an interest rate that's higher than the interest rate Lending Club is paying to the depositors. So that difference in interest rate, that is a net interest margin. So the concern here is that if inflation keeps rising, the people who deposit their money with Lending Club are going to expect a higher interest on their deposited money so it can keep up with inflation, or at least keep growing in a meaningful way. And that will increase their interest expense, their cost of its capital. And the interest rate that they've locked in on all of these loans might be lagging that increasing interest expense, if that makes sense. So say I issue a loan for 7% here to a borrower, but all the people who are depositing money, I'm starting to increase their interest rate as this loan stays at 7%, then that net interest margin is starting to shrink, right? But again, as answered by Lending Club themselves, that interest rate that they're issuing loans at is being repriced so frequently, their net interest margin should be protected and maintained. It might just see some periodic headwinds. Finally, defaulting and delinquencies on their personal loans. As I hinted at before, Lending Club's customer profile is generally high income. Prime borrowers with about 700 FICO score and average payment to income as of Q4 2020 was about 8%. Their risk model also had resulted in some of the lowest delinquency rates in the industry most recently. That said, as I've said before, in the event of a recession, pretty much all bets are off. In the Great Recession, delinquencies hit record highs, but keep in mind, in this particular recession, it was a very unique financial situation where mortgages were being written left and right with no regard to credit worthiness. So, of course, delinquencies would skyrocket in a crash that was caused by a lack of credit checks. And since then, many regulations have been put into place to avoid this from happening again. All in all, I think the current market environment is neutral/bullish for Lending Club, but if we see a recession, it's probably neutral/more bearish. In the event that we don't see a recession, we just see higher interest rates, I'm still bullish on Lending Club, and everything in my initial thesis on them, again, linked down in the description below, remains intact. That said, I continue to buy Lending Club as a potential multi-bagger for the future, and I hope you guys enjoyed this video, so make sure to subscribe.